What is up? Welcome back to another video. In this video, I'm going to be talking about fair value gaps. So in the last video, I taught all about liquidity, and in the first video, it was all on about what a candle is. So hopefully last video was nice and simple, and now you guys know what liquidity is. And now we are also going into another ICT concept, which is fair value gaps. So firstly, what is a fair value gap? So all a fair value gap is just a inefficiency in the market. So what this means is it's just where orders are laying in the market where price hasn't filled yet and price will most likely want to go to. So if you look at the chart here, the way you're going to want to find a fair value gap is you must have 3 candles. So if you look at 3 candles, then the candle in the middle must not be connected by any of the candles next to it. So as you can see, we have these 1, 2, 3 candles right here. Just say these are candles, and then we'll go into the live charts after. As you can see here, this point of this candle and this point of this candle do not touch. Therefore, this candle in the middle is just on its own. It has no wicks or no candle bodies touching it. As you can see, we have 1, 2, 3 candles. Then this wick from the first candle and the wick from the third candle are not touching at all. So therefore, this is where the fair value gap is. Now, let's say that this wick was lower and then this wick was higher, then there would be no fair value gap here. So you see how the first candle now and the third candle now are connected, so therefore there is no fair value gap. Whereas if the candle was like this, and then there is a gap in between the first, second and third, there is a gap between the second candle, then this is exactly where the fair value gap is. Now, if you're looking at this rectangle and you're wondering why is there a line there, that is just because I have a setting on which marks the middle of the fair value gap. And as you get used to fair value gaps and using fair value gaps more, this is actually quite important because sometimes the price action will want to come down, fill 50% of this fair value gap and carry on. So hopefully you now understand what a fair value gap is. I'll go into the charts below and explain it more. So now we are in the live charts, and as you can see, hopefully there is lots of fair value gaps. So let's just focus on this point here that I've just rectangled. If we look right here, we can see a nice fair value gap. As you can see, we have 1, 2, 3 candles. So as you can see, 1, 2, 3. Then the third candle and the first candle can't be touching. So as you can see, this wick of this first candle, let me just draw it for you. This wick here, so wick, is not touching this wick here of the third candle. Wick. So as you can see, there is a nice gap there, and this is the fair value gap. Now, if for example we look here at these 3 candles, as you can see, there is no wicks before this first, say this is the first candle there, and that's the third candle. As you can see, they are overlapping and connecting, so therefore there just is not a fair value gap. For a better example, let me look for an example that's moving upwards. So right here, let's use these 3 candles, 1, 2, 1, 2, and 3. As you can see, this first candle here and this third candle, they don't overlap, so that technically is a candle. As you can see, that is a tiny fair value gap right there, because this first candle and this third candle don't connect. But let's say if this candle here, this wick of this candle, was to come down a little bit and overlap this first candle, then there would be absolutely no fair value gap there. Okay, so I've shown you exactly what a fair value gap is. Hopefully now you can go into the charts and just recognize fair value gaps. For example, it's a fair value gap here, there's one here. So hopefully you can just go onto the charts and be able to recognize fair value gaps. And what you can actually do with that is you can now go into your charts. If you see a fair value gap like this right here, what you should do is draw the fair value gap, pick any color you want, and then just drag the fair value gap out to the right and see how price action reacts to certain fair value gaps. Now, when you have a fair value gap, let's say price action is bullish, so let's find a nice fair value gap. Actually, let's say if price is bearish. So right now on this day, price is bearish. So if my bias is bearish for the day, and then we create some bearish fair value gaps. So as you can see right here, this fair value gap here is created. So what I would like to see is price to come into a fair value gap and then carry on going to the downside. What I would not like to see, if my bias was bearish for today and we have fair value gaps, let's say that this candle's closed above these fair value gaps here, then this would then be an inverse fair value gap, but I'll teach you that in a minute. So just all I'm trying to say is, once you have fair value gaps and you have a bias, you want to see your fair value gaps respected, and you want to see price come in, tap a fair value gap, then carry on to its desired place. So right here, price comes into this fair value gap and carries on going down. Then here as well, price comes into this fair value gap and carries on going down. It doesn't matter if the wick goes above your fair value gap, as long as the candles stay inside of it, then your fair value gap is still valid. So I just mentioned a inverse value gap. So all an inverse fair value gap is just a fair value gap that gets violated. So as you can see here, let's say the price is bullish on both these legs right here. So let's say here price is bullish. So if the price is bullish and we create a fair value gap, I want to see price carry on going to the upside. Now if price is bullish and we have a major fair value gap, and then instead of price coming down and respecting this fair value gap, let's say price comes down and violates this fair value gap, then this price action is no longer as bullish as I thought. Now don't get me wrong, price can still come up to the upside, but it would just give me more conviction that price is no longer bullish. So once you are also looking at fair value gaps, and the way you want to find the fair value gaps that are more important than others, one way is you can go to different time frames. So for example, as you can see in this leg on the 1 minute time frame, we have many different fair value gaps, but whereas if we go to the 5 minute time frame, there is only one fair value gap. So right here we are in this 5 minute time frame and we only have one fair value gap. So if you see multiple different fair value gaps in one single leg, one way you can find a fair value gap that is going to be more dominant is to just go to a different time frame. That's what I like to do. So I like to use the 1 minute, the 2 minute, the 3 minute, and the 5 minute once using the fair value gaps. So I hope that helped out. I hope mainly for this video, what I want your goal to be is just to be able to recognize the fair value gaps. But as I was saying earlier, if we were bearish on this price action, so let's say we are bearish on this price action here, then we see a bearish fair value gap created. We want to see that respected and not closed above. See how this candle respects this fair value gap, then carries on going downwards. Let's say if this fair value gap was closed above, so instead of this downwards candle here, this is actually a bullish candle and it closes above like that, then that would give me a lot less conviction that we were still bearish. Then I would most likely want price to go to the upside. But don't worry too much about that now. I will go more into detail in future videos. All I want you guys to be able to do is just to be able to identify fair value gaps and just go into your charts in your own time and just look at how they are respected in the market.